you know that in most states, your credit score could be costing you hundreds of dollars a year on your car and home insurance? And here's what really gets me. Many people have no idea this is even happening. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Let me share something that came across my desk recently that connects two areas people don't usually think about together: credit scores and insurance premiums. Now, if you live here in California, this doesn't apply to you. Same goes for Massachusetts, Michigan, and Hawaii. But if you have family or investment properties in other states, or you're planning to relocate, pay attention. Here's what's happening. Insurance companies in most states use what they call a credit-based insurance score as one factor in determining your rates. Notice I said one factor, not the only factor. They're also looking at things like your zip code, driving history, the type of car you drive, and how many miles you put on it each year. But here's the important part, and this ties directly into strategic debt management. Research shows that people with lower credit scores tend to file more insurance claims. Whether you agree with that correlation or not, it's affecting pricing in most of the country. So what does this mean for you? Think about your budget. We talk all the time about the household blended interest rate. That's the weighted average of all your debt costs. But your credit profile isn't just affecting your mortgage rate or your credit card interest. In most states, it's also affecting your insurance costs, which is money leaving your household budget every month. I had a client recently who was refinancing to pull out some equity for a business opportunity. Great move from a strategic debt management perspective. We were repositioning high-cost debt and creating better cash flow. But during our conversation, I asked when he'd last shopped his insurance. He could not remember. Turns out his credit score had improved significantly over the past 3 years since he'd been working with us on his debt strategy. We got him connected with a trusted insurance professional, and he saved over $800 a year just by getting his policies requoted with his improved credit profile. $800 a year might not sound like a fortune, but think about it this way. That's money that could be going toward building wealth instead of leaking out of your household budget unnecessarily. Here's my recommendation. If you're working on improving your credit, paying down balances, making timely payments, clearing up old disputes, don't just think about your next mortgage or refinance. Think about the ripple effects through your entire financial picture. And if you live in a state where this applies, make it a point to shop your insurance every couple of years, especially if your credit situation is improved. You might be surprised at what you find. And I'm just going to throw this out there because I can. If you're in one of those states I mentioned that they are not allowed to use your credit score, don't you think they're probably using something else that might replicate that? The insurance companies are not stupid. They're much smarter than the government. So again, that's my opinion. They'll find a way to get the information they need compliantly. Bottom line, if you're wondering whether your financial house is in order, your credit, your debt structure, your cash flow, simple tool that walks you through the key steps. You can grab it at rsrlinks.com/keysteps, rsrlinks.com/keysteps, and find out. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. And remember, strategy beats rate always, and sometimes that strategy means looking at the connection between different parts of your financial life that you might not think are related. That is Your Credit Matters, brought to you by rsrlinks.com/debt-free, rsrlinks.com/debt-free.